Welcome to Nomad Investing. Today we're taking a look at Fiserv. Fiserv is a legacy company that most people have probably never heard of, yet it powers a huge part of the global financial system. And recently its stock has crashed more than 65% this year, from over $230 down to around $65. So what happened to one of the biggest financial technology companies in the world? And is this massive drop an opportunity or a warning sign? Let's break it down. Overview. Fiserv, ticker FI, is a legacy financial technology company founded back in 1984. And even though most people have never heard of it, it quietly powers a huge part of how money moves behind the scenes. They make money by providing payment processing, merchant solutions, and banking software. Basically the digital plumbing that keeps the banks, merchants, and card networks connected. Fiserv operates through three main business segments. First is merchant acceptance, which includes Clover, their point-to-sale system for small businesses. Every time somebody pays with a card or a phone, Fiserv earns a small fee. Second is financial technology, where they sell core banking systems and digital tools to banks and credit unions, helping them manage accounts, payments, and fraud prevention. And lastly, payments and network, which handles card transactions, bill payments, and money transfers between banks and other financial institutions. Now you might be thinking, this sounds a lot like what Visa and MasterCard do. Well, yes and no. Fiserv operates on a different layer of the payment system. Visa runs the network. Think of this as the train tracks that moved money between your bank and the merchant's bank. Fiserv, on the other hand, builds the infrastructure on both sides. The train station, ticket machines, and connections that make those transactions possible. So Visa doesn't compete with them. It actually relies on companies like Fiserv to handle the software, processing, and data systems that keep everything running smoothly. And now you might be asking, why doesn't Visa just do what Fiserv does? Mainly because the margins are much lower, the operations are more complex, and there's far more risk, especially if merchants or banks run into financial trouble. And now you might think, so should I just buy Visa instead? Well, you'd be right and wrong. Visa is an incredible high-quality company, but also priced like one. Fiserv, on the other hand, might not be as flashy, but it's trading at a much cheaper valuation. And that's where the potential opportunity lies. Financials. Now let's look at the numbers. Unadjusted earnings per share have climbed from about $1 in 2012 to roughly $6 TTM. A six-fold increase in just over a decade. Forward adjusted EPS sits around $8.6 now. That kind of long-term growth looks great on paper, but what really triggered the sell-off was the company's cutting on its growth outlook, dropping expectations from over 10% to just low single digits. At today's price of around mid-$60, the forward PE based on the adjusted numbers sits around 7, while the unadjusted sits around 10, which look cheap compared to the other fintech players that trade much higher. Still, cheap doesn't mean risk-free. The company's market cap has crashed from nearly 100 billion to about 35 billion. Short interest remains low, so this wasn't a big short attack. Just investors reacting to weaker outlook. Revenue per share has been climbing steadily for years, and operating margins have stayed strong. But the recent slowdown makes investors question whether that momentum can continue. Now on to the things I don't like. Fiserv's tangible book value is deeply negative because all of the goodwill and intangibles from years of acquisitions. Meanwhile, the long-term debt has also risen sharply, which adds risks when the growth is slowing. Fiserv keeps all its cash instead of paying a dividend, but the returns on money aren't exactly exciting. Then there's the capital allocation. The company spent billions on share buybacks when the stock price was much higher, destroying value now that the shares have crashed. Around the same period, the CEO sold parts of his holdings before announcing he would leave the company. And because of how his compensation and moving to the government to work, he avoided paying taxes immediately on those gains. All of that looks bad in hindsight, with the stock now sitting far below those levels. So while business itself is still solid, profitable and trading at low valuations, the combination of slower growth, rising debt, and questionable timing in management decisions has clearly shaken investor confidence. Future. Fiserv's future hinges on the continued growth of digital payments, banking technology, and merchant solutions. But because Fiserv is so deeply embedded in global payment systems, it's not going anywhere anytime soon. The company has been steadily shifting towards more recurring software-driven revenue, especially through its Clover platform and digital payment infrastructure. A smart, long-term move that brings higher margins and stickier customers. A large share of its revenue comes from percentage-based fees on payment volume, meaning that as spending and transaction volumes rise, so does Fiserv's income. If you spend 100 today and 200 tomorrow, Fiserv earns roughly twice as much in fees. So if unemployment rises, volumes get lower. Or if inflation rises, volumes get higher. Still, there are risks. The biggest short-term headwind is the financial sector slowdown, especially among the regional banks that make up a major chunk of Fiserv's client base. If banks cut on tech spending, it could weigh on the growth. Competition is another concern, with Block, PayPal, Stripe, and other fintech moving faster and innovating aggressively in digital payments. And of course, the collapse over the past year has investors questioning what the market is seeing. It might reflect fear about slowing growth and leverage, but these will mostly only affect the valuation in short term. But with earnings still holding strong and the company's scale giving its staying power, there is a real case here that the market may have overreacted. Intrinsic value. So what is Wiser worth? There are both unadjusted and adjusted EPS figures, but to stay conservative, let's stick with the unadjusted number, about $6.50 trailing 12 months. Analysts expect flat or slightly negative growth in the near term, followed by a strong recovery later. I'll take a more cautious view, around 0% growth for the next 5 years, then 4% growth for the next 5 years after that. And as always, I'm looking for at least 12% returns on my money. Historically, Fiserv's PE ratio has been high. The median is around 29. But today it's only 7 to 10 depending on how you measure it. If the company can return to even modest growth above 2%, I think a PE ratio of around 12 is reasonable over the next decade. With these super conservative assumptions, the intrinsic value comes out to roughly $69 per share, which happens to be around where the stock trades today. Fiserv looks like a strong but shaken fintech player. Solid earnings, healthy margins, and valuation that now looks pretty cheap. The business itself is still generating plenty of cash, but sentiment around the fintech and the slowing growth has clearly scared investors away. If the fundamentals hold up and the growth stabilizes, this could easily be one of those classic market overreactions, where the fear drives the price down too far. But if their banking and merchant clients keep tightening their budgets, or if the competition keeps clipping away, the recovery might take longer than investors hope. Still, Fiserv is a massive established player in global payments and banking tech. It's not going away anytime soon. To me, this looks like a soft buy. I'm considering starting a small position and adding more slowly if the numbers start improving. That way I might miss a bit of upside if the stock bounces quickly, but I'll also limit my downside if the growth doesn't come back as expected. And of course, this isn't financial advice. Always do your own research before investing. Either way, Fiserv is definitely a quality company to keep on your watch list. So what do you think? Is Fiserv getting ready for a comeback, or is it slowly fading into irrelevance? Let me know in the comments, give this video a like, and subscribe if you haven't already. And as always, do not lose money and safe travels. Bye bye.